Imagine you could invest in an ETF that got you returns that matched T-bills. Very safe, very secure, and you got the T-bill rate of return, except that you didn't have to pay any taxes until you sold shares of the fund. So you didn't have to pay taxes on the interest income each year. You could hold it presumably for years and defer taxes. And when the tax bill finally came due, you could pay the tax as capital gains treatment rather than as ordinary income. Well, if that sounds too good to be true, it just might well be, but there is an ETF, the ticker is BOXX, B-O-X-X, that makes this very promise. And I've received countless, and I do mean countless emails from folks saying, Rob, should I put my cash in BOXX? Is that the way to go? And so what I want to do in this video is give you my understanding of how all this works and my take on this ETF. So we're going to look at a number of things. We're going to actually start by looking at the ETF itself. So what we're going to do, we're going to look at BOXX, and this is the website. I'll leave links to all of this below the video. Then I'm going to talk about how it works. Then we'll get to those tax benefits, the risk of those tax benefits. There are big risks. And then my take on the ETF. So as I said, this is the website for the ETF. It's put out by Alpha Architect. As you can see, here's the actual name of it. Alpha Architect 1 to 3 month BOXX ETF. But everyone just refers to it as BOXX. It's ticker BOXX. Now, how does this fund work? Well, it uses what are called box spreads. And if you have any, you don't need to understand how it works. I'm going to explain it at a high level. But if you want to kind of understand it, this video on their website will walk you through, I think, a fairly easy to understand explanation of a box spread. But basically, you can think of it this way. You create what they call a synthetic long position, right? So if I just went out and bought shares of an S&P 500 fund, I would be viewed as that's a long investment. I'm investing in the hopes that it goes up over time. I could short an index, right? That would be the opposite. So the idea with a box spread is you actually have a long position and a short position. And they use options to create this. So they don't just go out and buy shares of an S&P 500 and then also short shares of the S&P 500. But what they do is they use call and put options to create what they call synthetic long and then synthetic short position. I know the word synthetic kind of seems complicated, at least it does to me, but it just basically means we're using options to do this is effectively what they're doing and what that means. And I can show you a document that they have that kind of explains this. Here it is. And again, I'll leave links to all of this. And you can see they've got this synthetic long position in this hypothetical. All they're doing is they're buying calls in this hypothetical at a $4,000 strike price. They've got a short put. So they're buying calls, selling puts, and then they're doing the opposite in the synthetic short at 5,000. Now, I know if you're not into options, and I understand them conceptually, I don't trade options, I don't feel a need to. But at the end of the day, here's the real takeaway, and you can see it down here, and they're using S&P 500, that's what SPX is. The result of all of this is they're going to have $950 in outflows, right? Because they have to spend some money here, but they're going to get a payoff. They're going to get $1,000. And you say, well, gee, Rob, $5? What's so exciting about that? In fact, you can see here they've calculated the spread at 5.26. This is just a hypothetical. I want to stress this. But the point is, yeah, what they're trying to do is mimic T-bill returns. And that's, 5% roughly. Those are T-bill returns today. And that's what you get. And because they're offsetting these positions, the market risk is effectively eliminated. Now, that doesn't mean there isn't risk to this ETF. I think tax risk is a big one. It's what's called counterparty risk. Well, the people or institutions on the other side of these trades, will they do what they're supposed to do? I mean, there's other risks involved. But with a box spread, effectively, from a market perspective, you're almost, I guess, as guaranteed as anything else in life to get that difference roughly matching what you would get in T-bills. And in fact, even though it's a very new fund, it's only been out a little over a year, we can look at the performance. Let's do that. Here's the box in Morningstar. I'm looking at the performance tab. And by the way, the expense ratio, at one point, it's like 39 basis points. Morningstar now shows it at just under 20. But these performance numbers are net of those expenses. And you can see Last year, it returned 504. This year, just over 3%. If you can read those numbers, I know they're kind of small. We can compare that to good old regular T-bill ETFs that don't get fancy with all these box spreads and whatnot. SGov, that's just the ticker, is an iShares fund, and a little bit less expensive a ratio there. We can just go to the performance, and it was slightly better. It's 319, so that's 18 basis points better so far this year, about 10 basis points better in 2023. And then there's the T-bill, the ticker T-bill, U.S. Treasury 3-month ETF, and it's actually done even a little bit better this year, 332. I'm guessing the duration for this fund is a tad longer. We're talking months, so it's all short, but a little bit different than, for example, SGov, but 332, and it looks like they were the exact same. Yeah, 512. So both of those funds beat BOXX, by 10 to 7 or 8 basis points up to maybe 20. So what can we kind of glean from that? Well, I mean, it's basically performing like T-bills. It's underperforming a little bit, perhaps in large part because of the expense ratios. Keep this in mind. Expense ratios don't include transaction costs. So you pay those out of the fund as well. And when you're trading a lot of options, it's going to be arguably could be more expensive. But in any event, you see at the end of the day, when all that's factored in, maybe 10 to 15 basis points less so far. But then again, we're going to get these great tax benefits, or so the BOXX ETF promises. And so let's talk about that. So what the fund promises is, one, it's going to get treated as capital gains, not ordinary income. Normally for a T-bill in a fund, if you just go buy a T-bill like we do, it's going to be ordinary income. It's going to be taxed in the year you receive it. But there's no state income tax. So for us, we live in Virginia, where there is state income tax. It's not outrageous. It's not New York or California, but it's still, almost 6%. So we don't have to pay that. With BOXX, the idea is it's going to be capital gains treatment. So in that case, we would have to pay state income tax. I'll come back to that. But it's going to be capital gains treatment. And I don't have to actually recognize that capital gain until I decide to sell the shares. I might hold the shares for years, in theory. So that's the purported benefit of BOXX, and that's what's got everyone so excited. So the question is, one, there's really two questions. Is the tax benefit legitimate? Is that right? And then, just how important is that benefit, right? So let's talk about those. So first, let's talk about the tax benefit. And for that, I want to go to this document, which is the prospectus. This is put out for the Alpha Architect Fund. You can see it here. And it's interesting. I'm not sure everyone appreciates both the complexity of this fund, but more importantly, how the tax would work if the fund is correct. Okay, if their take on the tax laws is correct, how it works. So remember I said it's all taxed as capital gains when you sell, but I didn't mention whether it's long-term or short-term. And that matters, right? Because short-term capital gains are taxed at ordinary income rates. So we don't want that. That if everything got taxed at short-term capital gains, I guess we'd have the benefit of perhaps putting off paying those taxes until we sold the shares. That's a good benefit. But we'd end up paying the same ordinary income tax rate, whatever that might be. And if we go down here to page 4, and again, I'll link to all of this below the video, it's this paragraph right here that matters. It's referencing section 1256 of the tax code. And as longtime viewers know, I am not a tax expert at all, but I can read. And the sentence I want to point out for you is actually this sentence where it says, pursuant to that code, profit and loss on transactions in non-equity options, including SPX options, which is what they use here, are subject to a taxation at a rate equal to, here we go, 60% long-term, 40% short-term capital gains or loss, regardless of the fund's holding period. Based on the advice of its accountants, the fund expects that distributions related to the fund's positions, if any, will be characterized by the fund as capital gains with these preferential terms. So the way I take that, the way I read that is, if the fund is right, yes, it'll be taxed as capital gains when you sell, but only 60% of those gains will be treated as long-term capital gains. The other 40% will be treated as short-term capital gains. And that's a really important thing to keep in mind. Now, we need to talk about risk. Before we get to sort of my take on this, and do I think it's worth the risks and what are the real benefits here, we need to at least explore the idea that maybe the fund has this wrong and that maybe the IRS is going to have a problem with this fund. And for that, I want to show you two things. We're going to actually come back to this document in just a second, but I want to go to this, there we go, this Forbes article. Now, these are very complicated tax issues. And I'm not a tax expert on the easy tax issues. I'm certainly not a tax expert on the complicated ones. But I will leave this with you. Steve Rosenthal, the author, I don't know him. He's as you can see here, he does research and writing on tax at the Urban Brookings Tax Policy Center. And what he says is this fund could get into some serious trouble. And he goes through all of the explanations here. I'll leave a link below the video for you if you want to read it, but let me just summarize it for you. What he says is, look, this all goes all the way back to Lloyd Benson's time, and if you're older like me, you know who that was. That Congress and the IRS, they were concerned about folks taking what should basically be ordinary income, and through some financial shenanigans or complicated, synthetic this and synthetic that, magically turning it in to capital gains. And so there's a code, IRS code, it's 1258, that says, hey, if what you're trying to do does the things that are described in 1258, you might get it recharacterized as ordinary income. And a lot of it turns on this idea that is the investment's value, the growth in its value, basically comes down to just time. In other words, the longer you hold your money in there, the more you make. Is it just a time value type of investment? You can think of a savings account, right? It's paying 5%. Well, how much will I make? Well, it depends how long I keep my money in the savings account. That's the only factor, right? If you compare that to the S&P 500, that's not, the potential returns aren't just based on time, right? Of course, we know long term, if things go up, the longer the better, but there's a lot of factors that go into, say, how Apple will perform or a small cap value index will perform well beyond just how long you hold the fund. But when it comes to like a savings account, or this author argues, and I tend to agree with this, a fund like BOXX, your return, of course, the actual yield will go up and down a little bit, but and maybe even a lot depending on what interest rates do. But at the end of the day, your return is basically how long you keep your money in the fund, and that can trigger 1258 in a recharacterization. Now, there's more to it than that, and as I said, I'll leave a link to the article for you to read yourself. But I think there's at least a reasonable risk that this fund may not qualify for the tax benefits it's promising. Now, you may say, okay, Rob, fine. You read a little Forbes article. Anyone could Google that. But we don't even really know who wrote that. Guy, tax policy guy, fine. But he might be wrong. Well, he might be. But I want to show you this. We're going back to this document. Remember, we looked at this about the 60-40 split. It occurred to me that if this risk that this gentleman talks about in the Forbes article is really, potentially real, I bet they've disclosed this in the prospectus, because you got to disclose all your risks in a prospectus. And sure enough, you see all these risks, and you get to the tax risk. I love this. You've got investment risk is 3 lines. Management risk is just barely 4. Market risk, there's some market risk. Look at the tax risk. It's ginormous. And it, by the way, it specifically mentions section 1258. And it basically says, if this is considered a conversion transaction, that's the term that 1258 uses, this could get recharacterized, and that's a risk that you, the investor, you need to know about. And so there it is. Again, I'll link to this. You can read it for yourself. So at the end of the day, where does it leave me? First of all, I'm not convinced that even if the fund turns out to be correct in its analysis of taxes, and it can be treated as capital gains, I'm not convinced that there's a great benefit for that. So first of all, as I mentioned earlier, at 40% of it's going to be short-term capital gains, ordinary income. Number 2, it's going to be subject to state income tax, whereas Tbills are not. So that's going to also reduce some of the, in my case, up to 6%, it's pretty significant. I might pay 15% long-term capital gains, but again, that's only on 60% of the capital gains. And then I'm going to have to add 6% for state income tax. And then for the 40% that's short term, that's ordinary income, again, both federal and state. And I suppose if I were in the highest ordinary income tax bracket when I sell shares of this fund, maybe there'd be some advantage. But with T-bills, yes, it's ordinary income, and yes, I have to pay it each year, but I don't have to pay state income tax. And so at the end of the day, I look at this and I think, well, I'm not convinced that the tax benefits, even in a perfect world, are all that great. And plus, I'm probably underperforming comparable investments that are just directly in T-bills, at least for the last year or two. They've underperformed, again, not a lot, 5, 10, 15, maybe 20 basis points. But when you add sort of what I think questionable tax benefits and now slightly lower returns, and by the way, if interest rates go real low, if you read the prospectus that I showed you just a second ago, it actually says you can lose money in this fund. Yeah, so you got that. I'm just not sure that the complexity and uncertainty is worth it. I don't know. Life seems complicated enough on most days. I see absolutely no reason to add these kinds of complications and uncertainties to our lives and my investment portfolio for what would be relatively small amounts of money. So that's my take. Again, I can't say that what BOXX is doing will eventually run afoul of the IRS and there'll be issues there. I don't know. I do know that some tax experts think that's the case, and I also know that BOXX itself has listed that as a risk in its prospectus. So that I do know, and for me, no thank you. So there you go. That's my take on BOXX. If you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom. And not a lot of uncertainty and complexity. I mean, really, who needs that?